What's up investors, Sneers here. Today I have another video about REITs. I made a video a while back about what is the best assets for inflationary environment, which we are still very much in, and REITs are one of the best assets to hold during an inflationary environment. And I'm making a lot of research about REITs, and I just want to share with you all the research about how to research that I make, and this video is just that. How I value REITs. Obviously, we can't just buy an ETF of REITs and be done with that and be fully invested in the assets of REITs as a whole, but I think it's better to be able to value REITs and buy the REITs that are pretty much on sale to make better returns. And also because of REITs right now, everyone have this genius idea of investing in REITs because they are great in an inflationary environment. So REITs as a whole is a bit more expensive right now. So if we can avoid buying the super expensive REITs and buy the great opportunity REITs through valuation, it will have us fared much better in the future. So that's what I'm trying to make, and this is what I hope to give you in this video. So let's start with the first method of valuation, which is called the net asset value valuation. Using net asset value to value REITs is the most common way and the most prominent way to do so, and is used by the biggest research firm in the field called Green Street Advisors. Using net asset value to value assets is similar to the book value valuation, in which we assess the value of the assets within the company to give the company the value itself. Basically, we look at all the real estate assets of every REIT and we give a fair value to each asset, and then in combination with all the values of all the assets, we get the value, the net asset value of the entire REIT. Now, assessing the value of assets of a company is usually not the way you value regular companies, and that's why the book value valuation is pretty much dead in the stock market. But in REITs, it's still relevant because in REITs, the assets themselves are the main component of the income producing assets for the REIT. For companies, it's no longer relevant because if you try to assess Apple, Microsoft, or Netflix using their net asset value, you will grossly underestimate their value because you will underestimate the value of the IP, the value of the brand, and many other things like that. But these kind of things are less relevant in REIT because in REIT, the asset is the value. You just rent out the offices, the houses, or whatever, and you get the money back. There is no IP usually. There is almost no brand. So these kind of things don't matter. That's why you can use a valuation more leaning into the assets value, which we don't use in companies anymore. The process of valuation using net asset value is simple in terms of how to describe it, but it's hard in practice. Let's go over how we actually do it. The first step is calculating the net asset value of all the assets of the REIT. So we start with reviewing properties by the segment and the location of each property, where each variable is very important because if we talk about offices, it's not like talking about housing, which is not like talking about hotels. And a location in the center of a city is not like a location in the suburbs. Then we need to determine the cap rate for each group of properties or segment. And the next step is estimating the future net operating income for each asset. And of course, subtracting any capital expenditure for each asset like maintenance or investment in the asset to maintain its income. And then the last step is applying the cap rate we found to a 12-month forward-looking estimation of the net operating income that we found. So for example, if the net operating income in the next 12 months is $100,000 and the cap rate estimated for this type and this region is 10%, the net asset value is the multiplication of both, which leads us to a $1 million estimated value. Now, all of this might sound simple, but in practice, it's very hard to estimate the net asset value of each property or estimating even the income or estimating the cap rate because you need to compare it to something, and sometimes you don't have anything to compare to, and sometimes the market move very fast, but even if you are able to estimate it, it will not be relevant in 12 months or whatever time frame you are looking at. So simple in description but hard in practice. Then after we calculate the net asset value of all the properties in the REIT and we get to a certain number, we need to adjust this number by several factors. First, let's talk about the things we need to add to the valuation. The first thing is the value of lands. A REIT can hold many lands that are not developed yet, and we need to adjust for that. The next thing is development value. So every asset that is currently under development can raise in value when the development will be done, and we need to account for that too. The third thing, equity. Equity, it means all the money within the REIT. So if the REIT have a lot of cash holdings or a lot of debt in the other side, we need to account for that proportionally for the valuation. And the fourth thing is other incomes. So REITs today have many other income streams like investments and any non-real estate businesses and management fees of the businesses they are run on the assets they hold and things like that. After all these additions, we need to start to talk about what we subtract from the valuation. So first we need to subtract debts, as I already talked about, and then we need to subtract the higher than market interest rates. So if a REIT is in a bad position that they pay very high interest rate on their debt, it means that their debt, even if it's exactly similar to other REIT, it's worth much less because they pay high interest rate on the same amount of money. So we need to account for that. Next, we need to account for government subsidies, and many REITs have many government subsidies, and we need to adjust for the subsidies as they might go away. It's just something we need to pay attention to. And the last thing is outstanding preferred stock dollar amount. So that's the process of valuing a REIT using net asset value valuation. But now let's talk a bit about the consideration around it. First, this kind of valuation doesn't take into account any growth of the REIT because it calculates only the current net asset value of every asset within the REIT. So even if a REIT is really growing really fast and the management is fantastic, it doesn't take that into consideration because it's not in the formula, which can be a good thing compared to valuation using multiples like the price to FFO, which I will talk about soon, because this kind of valuation might overlean into the growth figures, which are not really reliable or at least not sustainable in the REITs world. And I go really into details about how REIT growth in another video I made about how REITs grow, and you can see the link in the description below. But of course, there's also a downside to only consider the current value of each asset. For example, in the market in 2009 and 2010, the net asset value valuation showed that almost every REIT overpriced because it calculated the net asset value compared to the current value, which is right after the crash of 2008 was very, very low. But by that point, we already knew that the market is recovering. So it didn't make sense to use the net asset value that is valuing the assets so low when you try to value REITs. So if you only used the net asset value valuation method, you wouldn't invest in one of the greatest point to invest in REITs in the entire history. One more thing I want to talk about, and I already mentioned it, calculating net asset value is very hard, and making a mistake of, let's say, about 1% in the cap rate you use in the calculations may get you into a result that doesn't have any holdings in reality. So it's hard to calculate, and you need to consider that it's very error prone if you're not super professional and know what you're really doing, which leads this kind of valuation method only to be viable if you're really professional and you are able to estimate all the numbers of all the REITs, or in another case, if a REIT is grossly undervalued, but it's obvious even within a big margin of error, so it makes sense. But that rarely comes, although I think it did come right now for some companies that I research, but just know that it's a risk. And the last point that will lead us to the next valuation method is that net asset value valuation treats the REITs as a collection of assets and nothing more. And that's okay, as I already mentioned, but in the last few years, there is a movement that makes REITs a lot more like companies. They have other businesses running within them. They have investments. They have even starting to build a brand name to market to consumer in some points, or to other businesses that need to rent the assets. So there is a value to the brand. So it's starting to move more and more toward a status of a company. So using just the net asset value might not be entirely viable moving forward for some of the REITs, and it's a trend moving forward every year, so we need to attend to that. And with that said, let's go to the next valuation method. Guys, before we go into the next valuation method, if you can hit the like button for me, as it helps me a lot to grow on YouTube, and it helps me keep creating this kind of content. That will help me a lot, and I will really appreciate that. So thank you. The next valuation method is price to FFO. Price to FFO valuation is similar to the PE, price to earnings valuation, in which there are two multiples valuation, but in REITs we usually use the FFO and not the earnings, because FFO is much more reliable term. And if you want to go into the details about it, I made another video about why we use FFO and not earnings in REITs, so you can see it in the description below. And as I mentioned, using this multiple is more valid as we treat REITs more and more like businesses, where we use the income from the business, the FFO in this case, as the indicator and not the asset that it holds, using the net asset value valuation. But of course, using this valuation have all the caveats and all the benefits in the other side of using any multiple based valuation like price to earnings. For example, this valuation doesn't consider any other financial factor from the REIT, for example, debt. So a REIT might raise a lot of debt, a lot of unhealthy debt to buy more asset and then grow their FFO artificially. So if you only look at the price to FFO figure, you might see a rapid growth, and you might see like the REIT is undervalued, where in fact the REIT is in high risk because there is a lot of debt. And you will not miss it when you calculate using the net asset value valuation, because considering debt is included in the formula. So using this multiple, just like using PE multiple, is very valid and very helpful in many terms, for example in comparing to other REITs. But when you assess a REIT, you should not use it alone, because it hides a lot of risk factors. And if you only use the price to FFO, you might invest in REITs that are not really worth what it seems like they're worth based on this multiple. So it is a powerful tool, but you always need to use it in combination with other tools. Next and last to this video are a combination of two methods, the discounted cash flow method and the discounted dividend growth method. And I combine these two methods because both of them are considered discounted future cash flows for the valuation. I won't go into details about how we calculate the discounted cash flow formula or things like that, because it's a subject in its entirety deserves for its own video and its own content, but you will see content about it in the description below if you're interested. But just in one sentence, discounted cash flow and discounted dividend growth model, they are both considering the price of time for cash, in which money now worth more than the same amount of money a year from now or 10 years from now. And every year that passes, the value of the money is a bit lower because you have other opportunities you can use the money for. So using that notion, we calculate the expected cash flow from the REIT using dividend in the dividend growth model or free cash flow in the DCF analysis model, and we discount it into the future according to the discount price of the money, which is calculated in different ways, and then we get to the value of the possible income from each. Now DCF usually uses free cash flow, but in the terms of REITs, many of the modelers that value REITs use FFO, or in this case AFFO, the adjusted funds from operations, which is a bit more accurate to calculate the future value of the REIT. Theoretically, after you calculate the future value of the REIT, you give it a terminal value. Let's say we calculate 10 years into the future, and then at the 10th year we gave it a terminal value, usually based on multiples like the price to FFO. In REITs, this is relatively easier to do when compared to companies, because in REITs the multiples are less volatile than companies. So this step, at least, the terminal value is easy. But the step of calculating the income flow for the next 10 years, that's not so much easy, because you need to estimate how much the REIT will grow its income in the next 10 years to calculate and discount its future income. And predicting that is almost impossible at times. But if you feel like a REIT is very stable and it's growing very slowly, or in a very stable pace, so you feel like you can estimate the growth over the next 10 years, which is sometimes crazy to think about. But if you are able to do that within a margin of error, you will get a very accurate result. And as for the dividend growth model, instead of taking the entire income, the FFO, AFFO, or free cash flow, you use the dividends that the REIT will pay as the money that you will discount from, which might make more sense as you won't see all the money from the AFFO, and REITs will rarely liquidate all their assets and pay back to the investors. So it might make more sense to calculate based on the dividends paid. In another video I made about the payout ratio, which you can again see in the description below, I talked about how many REITs have different approaches to what amount of their income they pay back to the investors. And one REIT, in the example I gave her, state in their policy that they will pay 75% of their income. That's their goal. So it makes the dividend payment very predictable. When calculating the value of this specific REIT, it might make more sense to use the dividend growth model, as you will be able to tell what the expected dividends, at least to the point of what the growth of the REIT is. You will be able to tell that more accurately, and then you will be able to maybe value based on this. So this model might be more fit here. Guys, that's it for the video. Check the description for all the videos I mentioned and more resources for the individual investors, and I hope to see you next time. Sneers out.